Hello everyone, I'm Brian Forrest, a Senior Financial Advisor and Certified Financial Planner with the investment firm Mandeville Private Client here in Toronto, Ontario. I've spent 30-odd years in this business with different firms across Toronto, and today I'm going to try to convey a bit of what I've learned over these many years. First of all, I'd say that most people out there who have even a minimal experience with the stock market understand the difference between a blue chip stock and a speculative trade. People, and by that I mean people outside this business, really don't have problems recognizing quality companies. Over the years, I've had the opportunity to have looked at and worked on thousands of portfolios, and in most of them I've seen the type of well-run, durable companies that deserve to be held by most investors. But the best portfolios, and by that I mean a series of investments that will make you richer and richer over the years, are always well organized. What most people fail to realize is that a portfolio of investments has to be designed with attainable objectives in mind. It has to have certain architecture. It has to follow a theme. And the best portfolios I have ever seen are not just full of quality stocks, they are also well organized in a comprehensive manner. To use an analogy, say you decided to have your own home built. I'd imagine you want to use the best quality materials available. You'd want a strong foundation, you'd want the walls to stand up to strong winds, you'd want the house insulated against inclement weather, etc., etc. Obviously, it's not enough just to buy quality materials. You have to buy the correct amount of materials, and everything has to be placed in the right order at the right time. If you look at a building, you will note that the foundation blocks are very strong, that they are all the same size except at the corners, they are all placed at the bottom of the house, and that the foundation is the first thing done. Similarly, you'll find the best portfolios have a strong footing of defensive positions that can withstand the sometimes violent upheavals in the marketplace. By defensive, I mean stocks, income trusts, or debentures that will not fall or will not fall as much as the market falls during a downturn. Here in March of 2022, we've gone through a severe downturn on tech stocks that began last November when fears of rising interest rates took hold. This chart shows the financial tech firm Affirm falling from over $150 in November to around $26 earlier this month, and that's a drop of about 83%. Now, Affirm may be a great company, but is definitely not a defensive position. Now let's take a look at Bell Canada. During the same time period, shares in BCE actually rose from about $64 in November to around $71 earlier this month for a gain of about 10%. In addition, Bell pays a dividend of over 5%. BCE exhibits defensive characteristics. A couple of things to note here. The character of a stock can change with time. Also, people may find building defensive positions a bit boring because you are not going to make a fortune overnight on these types of investments. To this observation, I would ask if any of you have ever seen a hockey team begin the game without a goalie in the net? The finest Stanley Cup winners have always had great goaltending. Another little analogy. This is a battle for returns, and a good general may send his army out to fight, but he also makes sure that his home territory is well defended. You have to have both aggressive and defensive positions in your portfolio. So the next question would be, how much of each? The answer depends on a variety of factors: your risk tolerance, your age, the general market conditions, and your overall financial condition, to name a few. Let's look at what an actual quality portfolio looks like today. As you know, here in March of 2022, we have experienced volatility in markets worldwide as we deal with high inflation, rising rates, supply-side issues, and the war in the Ukraine. During this period, the portfolio mix you are looking at actually rose in value. Now, this is the portfolio mix of an older person who has had a lot of investing experience and an average tolerance for risk. You see the fixed income position is only about 10%, which indicates that perhaps this person is taking on more risk than they should at this moment in time. However, if you delve into the portfolio a little deeper, You will note the type of industries this client is invested in. Here we see that the client has close to 30% invested in the finance area, which includes insurance and banks. In the Canadian market, this is an area that has avoided the downturn of the tech sector. Also, the entire portfolio has an income yield of about 4%. So, regardless of the market's ups and downs, income from reliable companies continues to flow in. Income is a defensive mechanism. Also note that as oil has reached about over $112 per barrel, that the client has over 6% invested in the energy sector, an example of adapting to market conditions. The entire exposure to volatile tech stocks amounts to about 1%. Thus, this client has avoided the harsh downturn this sector has experienced since November. Note also that the client has a broad diversification across industries and that larger percentages are invested in lower risk companies. If you want your own investments to perform well over time, then your allocation chart should look like this one. Now, I'm not here today to recommend individual stocks or bonds. This is something you can see every day on television, over the internet, and in the finance pages of your newspaper. Also, in the short time allotted, I can't give you a complete course on portfolio management, but I can tell you that no matter which stocks you own, your portfolio will do better over time if you follow a few simple rules. Decide on the percentage exposure to the stock market as a whole. Determine the percentage of high risk, medium risk, and low risk investments you want to own. Determine the amount of income you want to see flowing into your portfolio annually. And as your portfolio grows, do not allow any one stock to become the gorilla in the portfolio. No one holding should exceed 8 or 10% of the whole. Now, to determine how much money to invest in each security, divide your total assets by about 30. That's a good number to start with. Larger amounts should go into lower risk areas and smaller amounts in high risk. Never invest an amount in a high-risk security that can seriously damage your portfolio should that security fall by 50% or more, and do recognize that stocks can fall to this degree. Do not be led astray by fads of the day. Diversification across sectors is your best strategy, but perhaps you can add a higher weighting to that sector that is currently outperforming. The chart behind me shows that the best performing stocks one year can become the worst performing the next. For instance, the chart shows that energy was tops in 2016, but by the next year in 2017, it fell to the second worst category. Don't be completely swayed by the last thing you read about a company. Remember that no matter how reasoned an opinion may sound, there is always a contrary opinion out there that will be just as well thought out. That's why there's a market. Every day when stocks get traded, there is one person who thinks selling is a great idea and another who thinks buying is. Well, that's all we have time for today. If you have any questions about the arrangement of your portfolio, send me a note at bforrest@mandevillepc.com. Goodbye, and may all of your investments cause you to prosper in the years ahead.